You should look for the job that you would want to hold if you didn't need a job. I mean, you're probably only going to live once. You don't want to go sleepwalking through life, and you're really, whether you make X or 120% of X, really isn't remotely as important.
Warren Buffett once said, "If you don't find a way to make money while you sleep, you will work until you die." Imagine waking up to a life where your financial worries are a thing of the past, bills are paid, and the life you've always fantasized about is now a reality. The key to making this dream come true: the incredible power of dividends. In 2020, S&P 500 companies paid over $58 billion in dividends per month to shareholders. Historically, dividends have accounted for a substantial 42% of the stock market's total return. Today, we embark on a journey guided by Warren Buffett's wisdom to uncover the fastest way to live off dividends and secure a monthly payout of $4,700. Let's kick things off by understanding what dividends are and why they're crucial for achieving financial independence. When you invest in a company stock, you become a part owner, and when the company makes a profit, it can choose to distribute a portion of those profits to shareholders as dividends. Dividends are your ticket to making money while you sleep, a concept Warren Buffett emphasizes. They can be a steady source of income, making them essential for building wealth and achieving financial freedom. Warren Buffett's principles. Now, let's delve deeper into Warren Buffett's timeless principles that form the bedrock of successful dividend investing. Buffett not only believes in the power of dividends, but also emphasizes the significance of building a robust portfolio. According to him, diversification is a shield against ignorance, asserting that spreading investments across different sectors mitigates risk. This principle is crucial in the dynamic world of investing, as it ensures that the performance of one sector doesn't unduly impact the entire portfolio. Buffett further elaborates that if a company can't efficiently utilize its earnings, he prefers it to pay out dividends. This underscores the importance of assessing a company's ability to manage its profits effectively and distribute them to shareholders. Additionally, Buffett urges investors to adopt a long-term perspective. Comparing investment decisions to a punch card with limited punches, he emphasizes the need for thoughtful and well-considered choices. This long-term approach aligns seamlessly with the nature of dividend income, which can compound over time, especially when reinvested. Buffett's wisdom guides investors to make substantial and well-thought-out decisions, avoiding the pitfalls of short-term thinking.
There is nothing about the price action of the stock that tells you whether you should keep owning. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
Building a powerful dividend portfolio. Building a powerful dividend portfolio requires meticulous planning and adherence to key principles. The first step is selecting dividend-paying stocks with a history of stable or increasing payments. Sectors such as consumer staples, utilities, and healthcare often harbor such companies. Extensive research into a company's financial health, competitive advantage, and cash flow generation is paramount. Diversification, the second key component, involves spreading investments across different sectors and industries. This not only helps mitigate risk, but ensures that the portfolio remains resilient to market fluctuations. While dividends provide income, the value of investments can fluctuate, making diversification a crucial safety net. Buffett's third principle involves adopting a long-term perspective. Investing with the expectation of holding assets for an extended period allows for well-thought-out decisions and potential compounding of dividend income. This perspective becomes a valuable asset in the journey toward financial independence. Assessing risk is the next principle of building a powerful dividend portfolio. Buffett advises against companies with excessive debt or those prone to frequent dividend cuts. A focus on companies with solid balance sheets and a history of weathering economic downturns adds stability to the portfolio. Lastly, the fifth component involves regular monitoring and adjustment of the portfolio. Companies evolve and economic conditions shift, making it imperative to make necessary adjustments to ensure the portfolio aligns with financial goals. By meticulously following these principles, investors can construct a dividend portfolio poised to provide a steady stream of income and contribute to long-term financial goals. Strategies to achieve $4,700 a month. Now let's dive into the strategies to achieve the goal of $4,700 per month in dividend income. Strategy 1. Blue chip dividend stocks.
You look at the investment itself to deliver the return to you. Now, if you buy something, Bitcoin or some cryptocurrency, you don't have anything to produce anything. You're just hoping the next guy pays more.
Investing in blue chip dividend stocks is like building a strong foundation for your financial house. These well-established companies are known for their stability, solid track records, and consistent dividend payments. Buffett's advice to focus on resilience aligns perfectly with this strategy. By investing in these giants, you lay the groundwork for a reliable stream of income, providing stability, income, and potential long-term capital appreciation. Strategy 2. Dividend growth stocks. Dividend growth stocks represent a dynamic strategy that aligns with Warren Buffett's emphasis on lifelong learning and a long-term perspective. Unlike stable blue-chip stocks, these companies not only pay dividends, but consistently increase them over time. This strategy is rooted in investing in firms dedicated to reinvesting in their growth, innovative products, and services. Operating in industries with substantial expansion potential, these companies prioritize both research and development and rewarding shareholders with rising dividends. The appeal lies in the compounding power of these stocks, where the growing dividends become a percentage of the initial investment, significantly accelerating the path to financial independence. While initial yields may not be the highest, the long-term potential for substantial income makes dividend growth stocks a potent strategy for transitioning to a life funded by dividends. Strategy.
I bought my first stock when I was 11 years old. I spent $114.75. If I put that $114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today. The answer is about $400,000.
3. Covered call ETFs. Covered call ETFs introduce a unique twist to dividend income strategies by combining stocks and options. In alignment with Warren Buffett's advice on the stock market transferring money from the active to the patient, covered call ETFs require a patient approach. These investment vehicles hold a portfolio of dividend-paying stocks while simultaneously selling call options on those stocks. The strategy generates additional income by collecting premiums from buyers of call options. While this approach may cap potential upside if stock prices rise significantly, covered call ETFs are particularly attractive for income-oriented investors seeking enhanced dividend income without excessive risk. By incorporating these ETFs into a portfolio, investors can diversify income sources and potentially accelerate their journey towards financial independence. Math behind achieving $4,700 a month. Let's do some simple math to see how covered call ETFs with a 12% yield compare to traditional dividend investing with a 3% yield. The conclusion: covered call ETFs require a significantly smaller investment to achieve the same income level, making them potentially more appealing for investors looking to generate income with a smaller initial investment. Now, let's crunch the numbers to understand the financial implications of our strategies. If your goal is to generate $4,700 per month from covered call ETFs with a 12% annual yield, the math is straightforward. The annual income required is $56,400, $4,700 per month multiplied by 12 months. Dividing this by the yield percentage, 0.12 or 12%, reveals that you would need to invest approximately $470,000 in covered call ETFs to achieve your monthly goal. Comparing this to the traditional dividend investing method with a more typical 3% yield, the annual income required remains $56,400. However, dividing this by the lower yield percentage, 0.03 or 3%, shows that you would need a significantly larger investment of approximately $1,880,000 in traditional dividend-paying stocks to generate the same annual income. Whether you choose the power of covered call ETFs or opt for traditional dividend investing, remember that your journey to living off dividends is a marathon, not a sprint. Align your strategy with your financial goals, risk tolerance, and investment horizon. Both methods have their merits, and the key is to remain patient, informed, and invested. Which method resonates with you? Share your thoughts in the comments below. And don't forget to hit that like button and subscribe to our channel for more amazing content. Thanks for watching, and until next time, happy investing.